And let's be real, who doesn't love getting paid to simply own things? Need investment income? Dividend stocks are obviously your best bet. They're not just built to pay a perpetual stream of cash. For most quality dividend payers, these payments also grow over time, at least keeping up with inflation, if not outpacing it. With that as the backdrop, if you've got a couple thousand extra bucks, or any other amount of money, you're ready to put to work producing immediate income, here are 3 top-notch dividend stocks to consider buying. But before we jump into these 3 companies, do you want to know where to invest your money to earn steady dividends? Hit subscribe and turn on notifications for my top stock picks every week. Alright, let's kick things off with a company that might surprise you, British American Tobacco. Now I know what you're thinking, tobacco, isn't that like a dying industry? And yeah, you're not wrong to think that. There's little doubt that anti-smoking activists are winning the war against tobacco usage. But here's the thing, it's not happening as fast as you might think. Even right here in the US, where efforts to get people to quit are really gaining traction, almost 1 in 5 adults still use tobacco regularly. That's according to the CDC. And globally, the World Health Organization says there are over 1.25 billion smokers out there. Think about that for a second. Over 1.25 billion people. That's a massive market, and while it's shrinking, it's not going anywhere anytime soon. The WHO even predicts there will still be close to 1.2 billion smokers in 2030. So, what does this mean for British American Tobacco? It means they've got a pretty solid runway ahead of them. They're a global giant with brands like Camel, Newport, Pall Mall, Dunhill, and Lucky Strike. And get this, over half their business is done outside the US, which is actually a good thing. Why? Because the decline in smoking is happening slower in other parts of the world. But let's talk dividends, because that's why we're here, right? British American Tobacco has an incredible track record. They've been paying dividends consistently for decades, and they've been increasing them regularly too. Right now, their forward-looking dividend yield is sitting at over 7.6%. Now, full disclosure, because I always keep it real with you guys, there are some things to keep in mind. First, as a US investor, you're dealing with a company based in England, so exchange rates can fluctuate and impact how much you actually receive in dividends. Second, yeah, eventually the tobacco industry is going to face some serious headwinds. But here's the bottom line, for the foreseeable future, British American Tobacco is a solid dividend stock with a juicy yield. It's not a set-it-and-forget-it investment, but it's definitely worth considering if you're looking for income. Alright, next up, we've got a company that needs no introduction, Pfizer. They were the heroes of the pandemic, right? Their COVID-19 vaccine was everywhere, and their stock soared. But here's the thing about heroes, sometimes they have a tough time living up to the hype. Since their peak in late 2021, Pfizer's stock has been cut in half. Cut in half. Why? Well, investors are starting to realize that the vaccine bonanza wasn't going to last forever, and they're worried about what's next. Pfizer doesn't really have anything in their pipeline to replace that massive revenue stream. Analysts are predicting that it might take until after 2027 for Pfizer to see any real revenue growth again. I mean, last year they didn't grow their revenue at all. Not exactly inspiring confidence, right? But hold on a second, because I think the market might be missing the bigger picture here. Pfizer is a massive pharmaceutical company with a ton of resources. They're not just going to disappear. In fact, they've got some really promising drugs in development. For example, they've got Elrexfio for multiple myeloma, which is showing great results. They're also working on atirmociclib and vepdegestrant for breast cancer, and those have blockbuster potential. And let's not forget about their oncology drugs like Adcetris and Padcev, which I think are being underestimated right now. Pfizer's management is really bullish on their oncology pipeline, and they think they could have 8 blockbuster cancer drugs by 2030. That's a bold claim, but if they can pull it off, it would be huge. On top of all that, they're even getting into the weight loss game with a new pill called danuglipron. That market is worth billions, and if Pfizer can capture even a small slice of it, it would be a significant boost to their bottom line. So, here's the deal. Pfizer is going through a bit of a rough patch right now, there's no denying that. But I think this is a classic case of the market overreacting. They're trading at just 9.1 times this year's earnings, and their dividend yield is a very respectable 6.4%. If you're patient and willing to ride out the storm, I think Pfizer could be a great long-term investment. They're a company with a proven track record, and I'm betting on them to figure things out. All right, for our final dividend stock pick, let's talk about a company that's been a bit beaten down lately, Verizon. I'm talking about the telecom giant that's been connecting people for decades. Now, I know Verizon might not be the sexiest stock out there. It's not going to make you rich overnight, but you know what it is? Reliable. Like, rock solid reliable. Verizon's stock has taken a bit of a hit in recent years. It's down about 30% from its peak in 2020. And you know what? I think that's a huge opportunity for savvy investors. So why is Verizon's stock down? Well, there are a few reasons. First, the telecom industry is notoriously competitive. You've got Verizon, AT&T, T-Mobile, all fighting for the same customers. And let's be honest, there's not a ton of growth left in the traditional wireless market. Second, Verizon has been spending a lot of money on infrastructure. They've been building out their 5G network and investing heavily in fiber optics. And while those are smart long-term investments, they're also eating into Verizon's profits in the short term. But here's the thing, I think the market is way too focused on the short term with Verizon. They're missing the forest for the trees. Because while everyone is obsessed with 5G and consumer wireless, Verizon is quietly building a dominant position in two other massive markets. The first market is industrial and institutional wireless networking. Think about it, factories, hospitals, schools, they all need reliable wireless connections, and Verizon is perfectly positioned to provide that. The second market is fixed wireless broadband. This is basically high-speed internet that's delivered wirelessly, no cable lines needed. It's a game changer for rural areas and places where it's difficult to lay down traditional cable lines. And guess what? Verizon is already the leader in this space. So, you've got a company with a rock-solid core business, a history of paying out hefty dividends, and they're making smart moves to capitalize on two huge growth markets. And yet, their stock is trading at less than 10 times this year's earnings, and their dividend yield is a juicy 6.3%. If you're looking for a safe, reliable dividend stock that's also undervalued, look no further than Verizon. This is a company that's built to weather any storm, and I'm confident they're going to reward patient investors for years to come. There you have it, guys. 3 dividend stocks that I think are absolute steals right now. Remember, investing is a marathon, not a sprint. Don't get caught up in the hype, do your research, and focus on companies with strong fundamentals and a history of rewarding their shareholders. If you enjoyed this video and want more top dividend stock ideas, smash that like button, subscribe, and dive into this next video. It's packed with tips to grow your income even faster.